everyone, and welcome to the 2022 Annual Outlook event. We're pleased to see our leading experts today who will take you through the discussion of asset classes, regions, and currencies that may lead the way in 2022 and beyond. And before we start, let me introduce the speakers of today's roundtable. Guillaume Minuet. Guillaume is the head of investment strategy and economics for Europe, Middle East, and Africa. He is a member of the Office of Chief Investment Strategist and is responsible for identifying investment opportunities and risks in EMEA across asset classes, as well as representing the Global Investment Committee's views within the region. He has over 25 years experience in European economic analysis. Jeffrey Sachs. Jeffrey Sachs is a member of the Office of the Global Chief Investment Strategist and is responsible for identifying investment opportunities and risks in EMEA across asset classes, as well as representing the Global Investment Committee's view within the region. Jeffrey has over 30 years of experience in research, portfolio management, and investment advice. And Julian Carney. Julian Carney is the Managing Director and Head of EMEA Foreign Exchange at Citi. His team provides investment advice and execution services across foreign exchange, covering both cash and derivative products from London, Luxembourg, and Geneva. Gentlemen, thank you so much for participating. And over to you, Guillaume.
Thank you, Anna, and good afternoon to you all, and best wishes for this new year, which is likely to prove quite exciting, I suspect. This session, we hope, will help you understand what we see as a changing market environment. It's changing because the pace of recovery is adjusting, and this is going up in terms of growth. The outlook is positive despite the rapid spread of the Omicron variant. You can see from the title of the presentation, we are confident that this expansion will endure, but the year will be markedly different from 2021. And as such, we recommend some adjustments in portfolios, with the priority being one of seeking sustained returns. I will, through the oncoming slides, show why we've come to that conclusion and what investors should be focusing on during a year that we think will be quite eventful. Next slide, please. So when we look at the economic views for 2022 and the thematic views and beyond, despite the emergence of new variants and given the backdrop of remaining stimulus, creating some distortions, the environment is slightly different from what we had last year, but we strongly believe that the expansion will endure and that it will provide a period of economic growth that will extend beyond what we see as current challenges. In case of absence of boom, absence of bust, what are you left with? You're left with something in between, which is a gradual slowdown in the pace of economic activity and a gradual slowdown in inflation. And when we think about slightly lower nominal GDP growth, it's also translating into a more modest rate of expansion in global earnings per share, which we see into a high single-digit territory. At the same time, given the repricing that's underway in terms of the policy stimulus to be delivered by global central banks, we expect some fall in the price of fixed income instruments, and we see some upside in yield, especially for the US 10-year Treasury yield, which we think could rise by 35 to 40 basis points from the current level of around 1.75 to slightly above let's say 2.1% by the end of this year. So it's going to be another challenging year, most likely for fixed income. And to mitigate this, we continue to recommend being underweight of this asset class. At the same time, we still see attractive opportunities focusing on sustainable income creation. We like some aspects of private markets, and we also think that using capital markets to enhance yields is the right way to go. Next slide, please. Let me turn to the first significant inputs in anybody's outlook for 2022. It has been the surge in COVID cases of late, especially the very rapid spreading of Omicron. Yet we are starting to see clear evidence from public health data that thanks to much higher levels of vaccination, multiple doses of vaccines, and a much smaller number of people which have needed intensive care support or hospital care in previous waves, that's the impact on economic activity is going to be much lower. This pandemic might be unfinished, but gradually we think that COVID-19 will become endemic. And therefore, as we go into 2022, therefore not worth worrying about too much from a macroeconomic standpoint. At the same time, this pandemic has created some slight structural changes in some aspects of the economy that will probably persist, one of which perhaps is business travel or workplace visits, as shown on slide 3 on the right-hand side. Nevertheless, I think that the global impact of COVID on the economy, whether it's the global economy per se or more local markets, we think will diminish noticeably. Let's move on to slide 5, please. What we are trying to indicate on slide 5, showing the table of global growth forecast, is that this will be a negative year in terms of deltas, i.e. the growth rate of 2022 GDP will be lower than what it was in 2021. The slowdown globally is about 1.8 percentage points to 3.8. The US slowdown is slightly bigger, 2 percentage points to 3.5%, whereas the EU slowdown is very modest, we think around 1 percentage point. China stands out as perhaps the most decelerating economy of all, given that you're looking at a 4.5% growth rate down from 8% last year. But in absolute term, it's going to be one of the fastest growing regions in the globe. And going into 2023, i.e. next year, we still think that this mid-cycle theme will continue to dominate. Just as a sort of an aside, we are very far from end cycle, which would be a situation I would describe as the economy operating well above, beg your pardon, potential, and central banks obliged to respond aggressively to increasing price pressures with additional rate hikes. I would argue that recoveries, like the ones that we see today, they simply don't die of old age, they die of excessive leverage. And I don't detect a situation that would resemble that particular scenario today, certainly not at the prevailing level of rates, let alone the very modest further increase in rates that we're expecting by year end. The quick takeaway, I think, from the chart on the right is obviously that there is going to be some slight slowdown in EPS growth, but to a still robust 7 to 8% per year. So less strong returns, slower growth, but certainly no contraction. So any worries about recession, I think, are far premature and would take a lot more time, I think, to materialize. Next slide, please. The point of that slide is to illustrate that economic growth will slow because the impulse behind growth, especially from the fiscal angle, is going to be much less than it was throughout the course of 2021. You can see the big spikes in the blue line. They were just unprecedented in terms of the scale of support if we compare to what degree of stimulus was given during the great financial crisis. So when there was a need for a lot of counter cyclical stimulus, central banks did so, but when the need for stimulus disappears, it is quite normal that some normalization takes place. So as the first chart illustrates, the expansion of the fiscal stance is not going to be possible this year. It's very unlikely that even what's being debated in the US Congress will have a material impact on global GDP and the US economy in particular. At the same time, there is undoubtedly a lot more uncertainty about the Fed. The excesses of the past in terms of balance sheet expansion are going to have to be worked through, but we're going to be waiting with bated breath for the explanation from the Fed, perhaps already at the meeting in on Wednesday, about what they want to do in terms of the proportionate use of the two levers that they have in terms of short-end rates and balance sheet reduction. The uncertainty about the balance sheet reduction, I think, and the liquid withdrawal that the economy could suffer is one of the reasons why I think markets are starting to rethink the global risk appetite. If we move on to page 7, please, we are illustrating here that the world is transitioning towards less loose or tighter monetary policy, essentially led by emerging markets. There have been some examples recently of rate cuts, and China is going to be a good case in point. But more central banks have been hiking rates in the last 12 months than those which have been cutting interest rates. So that points to this gradual step towards the normalization process. Next slide, please. So central banks are doing this. Why? They are doing this to react to an inflation situation, which has clearly been much higher in 2021. For 2022, we think this is going to be a year of transition for inflation. The reason why this is going to be slower, we think, is because there's going to be less volatility or fewer large swings in the demand for goods and the demand for services. Demand for goods in orange, demand for services in blue. This is because global supply chains are normalizing. And if that is the case, and if the imbalance between supply and demand adjusts, inflation should moderate, especially when you have very large base effects kicking in, lowering the annual rate or the 12 months rolling rate comparisons that people are used to. So what mattered in 2020 and 2021 was the speed at which demand moved as preference shifted. And producers could not keep pace. So you saw this massive increase in demand for goods. In the space of 2 years, it increased by as much as things would have increased by 10 years under normal circumstances. And by contrast, the consumption of services is still lower than the one we had in late 2019. So it's not surprising in this environment to see on the right-hand side of the chart, those increases, very sharp increases in raw material prices. So with less stimulus, whether it's fiscal, whether it's monetary, and pace of demand moderating, we think that with new data showing rising production of goods and rising imports, we think that supply will meet demand at an acceptable level. So there will still be inflation in 2022, but certainly less than what we had in 2021, especially when we go towards the tail end of next year. Let's move on to slide 9, please. Next one. So what do we think about inflation medium term? Well, there's been a mandate change by central banks. They are slightly more accommodative towards a higher level of inflation. The Fed has moved to flexible average inflation targeting. The ECB is now going 2% symmetric. So we think inflation is going to be slightly higher in the next 10 years than it was in the previous 10 years. That would be quite logical. Given this sort of slight change of focus. So it's logical to adjust portfolios for slightly higher inflation, but we don't believe in hyperinflation. We don't believe in stagflation. That's not a word that we would use easily. I don't think that the global economy has deglobalized enough, basically, throughout the crisis, throughout this pandemic, to worry about the impact of re-onshoring of some services, of some good production. And we don't think that there is going to be a fundamental change, persistent change in the labor market, for instance. So we are seeing some evidence of wage acceleration on the blue line on the left. You can see that the cost of employment index is finally edging up, but it remains well within historical range. So if those services prices were to rise, that would create a little bit more inflation. But at the same time, don't forget what's happening to the orange line. Those goods price inflation surges are going to unwind fairly rapidly. So it's going to be, I think, very difficult unless we have another energy crisis or big geopolitical risk to think that energy prices can continue to surprise to the upside. Let's move on to slide 11, please. Here, we've talked about quite a lot of the positives. I'm talking about here a significant negative risk for the global economy, at least in the first half of this year. And it is coming from China because of the woes of the property market that this very large economy, second to the US only, is currently experiencing. You can see on the left-hand side that we've had big moves down in property sales historically, but maybe the drop this year is not as bad as it was. Recently, we've had larger falls, but the difference, let's say, with 0809 is perhaps this time that stimulus is not being geared towards protecting the whole of the economy. It is more geared towards providing a floor. It's a much more disciplined approach that the Chinese authorities seem to be effectively focusing on. The overriding initiative seems to be growth stabilization. So as and when the authorities deliver additional fiscal stimulus, we think that the credit impulse will turn positive, and there are signs of a move towards that situation, and therefore we will probably be looking at a growth rebound in the second half of this year. The biggest unknown for me on China is whether they will change their zero COVID policy, given the sort of relatively manageable approach of Omicron. Let's move on to slide 13, please. So when we've seen the peak in the global cycle, the peak in manufacturing, you've seen the PMIs, you've seen the various business confidence surveys suggesting that, yes, we have been very strong and now we're starting to moderate. What happens generally in terms of equity returns in the next 12 months after the peak in the manufacturing cycle? Well, in 8 out of 9 times, we see positive equity returns. In the average is low double digits when we look at the total cycle. How likely is a recession today? I don't think that it would be very similar to what we saw back in 1973 at the OPEC oil embargo, or 1991 when the Fed was reacting to a surge in inflation to effectively take policy rates to 14% in nominal terms and 9% in real terms. So in those 2 episodes of recessions, average equity returns were about 10% in any of those years. And if we take all the bad years with all the good years, many of which are obviously more numerous and see positive returns, the average total return is 7%. So we would continue to stay invested in those markets from the angle of, as long as we believe that we are mid-cycle, as long as we believe that there is decent EPS growth around the corner, it makes sense to play the overweight that we have in those equity sectors. There are 2 observations worth highlighting. The first is that we prefer to go for defensive industries, healthcare, staples. They are routinely outperform cyclicals in this environment. And we want to go for large cap share companies, which have got better balance sheets and which tend to outperform their smaller peers. Let's go to slide 14, please. Next slide. We've talked about Treasury yields very briefly earlier on, just to mention the fact that there's going to be probably an upward drift in long-term interest rates. It's not going to be, though, a very, very big move. We think that historically, the trough to peak is about 150 basis points in terms of recovery phases. And if we think that the trough in yields was about 60 basis points in the summer of 2020, then at 2.1%, we're there or thereabouts. So how much more upside are we going to see in those Treasury yields? Sufficiently enough to stay underweight, I think, the global fixed income complex and certainly government bonds. But it is perhaps possible, if you think about it, that the Fed withdrawing stimulus in the economy will also put a fairly firm cap on that upward trajectory in yields at a time where slower growth is going to be something that people start to embed into their forecast. And we still have large amounts of global excess savings. So in this environment, I think it's probably going to put a fairly strong lid on that upward trajectory of yields. Next slide, please. So what to expect in terms of curves? Curves are going to be, we think, still a fairly significant determinant in terms of certain sectors' performance, outperforming, underperforming. If you think that the sector is, if you think the yield curve is going to be steeper, then obviously it is something that you might want to look at in terms of financials, for instance, more cyclicals generally. If you think on the opposite side of things that the curve will be flatter because the Fed will hike quite a lot at the short end, and perhaps longer term growth expectations and inflation expectations will diminish because of that tightening, then obviously you want to go for clean energy, alternative energies, fintech, software towards the bottom of the table on the right hand side. If you're fairly agnostic, which I think is a very relevant and probable outcome to be had in 2020, then we think that dividend growers is very logical. It's driving safely down the middle of the road, as we would say. So if you're looking for income generation, those dividend growers make a lot of sense to us. Let's move on to slide 17, please. Here, let me just spend a couple of minutes on what I think is an important driver, given the topical aspect of the tech space. We're not expecting a significant decline in terms of spending in this very important part of the economy, which is growing in size, because this is one of the structural trends that the global economy is now developing. We take a comparison on the left-hand side of what was happening in the 1990s compared to what's happening now. In the 1990s, sure, there was this big IT tech boom, and that was a boom at a yield level of 7% for US Treasuries. Today, the yields are obviously very low. We're talking 175, 176.50 for the 10-year yield, as I see it on my screens. So it's slower growth, 7.5% in terms of investment in IT tech equipment. It's half the rate of the 1990s. And this is despite secular growth in e-commerce, which you see on the right-hand side. It's a segment which is likely to take a much bigger role in the economy because it proved to be very useful through COVID. And there is no going back. Once people get used to e-commerce, they will most likely have to have the capital outlays and the firms to do that in order to sustain the businesses. So tech investment spending used to be perhaps then tech is now going to be investment because tech becomes ubiquitous in more industries. So as this chart is suggesting, we don't think that there's going to be a meaningful fall, even in the event of a recession. So I think having significant exposure to tech, and Jeffrey will talk about this later, makes a lot of sense to us, especially from an unstoppable trend perspective and a sort of structural and secular angle. Let's move on to slide 20, please. Slide 20 is one where we talk about two things that we really want to be invested in. The first one is firms which produce consistent dividend growth. And second are good companies, quality companies within growing industries. And we also try to highlight the fact that dividends makes a lot of sense to us. And the charts on the right-hand side exemplify this particular angle. Not choosing companies paying dividends, I think, is very difficult to argue in favor of. There's very few companies which I think would have the long-term returns necessary to compensate for the absence of dividends more broadly. I mean, you can see that over the last 30 years or so, you would have lost more than half of your total returns if you didn't get a dividend payment and reinvested it. So at a time of greater volatility, at a time of economic activity slowing down somewhat, we think that this dividend premium, which is exemplified on the right-hand side by this S&P dividend aristocrat, it outperforms even the growth and the S&P values. So this is something that we feel very comfortable with in portfolios today. Growing industries, we've talked about good stock selection, quality companies, that makes a lot of sense to us. We can just show that again on the left, using some of the strongest growth tech firms compared to the raw index. Yes, some of these firms are being repriced, but it's still going to be, we think, some of the better quality names that you can find within the space. And when you think about healthcare versus the auto industry on the right-hand side, this is typically a phase that is upward sloping in terms of share of disposable income that consumer outlays are going to be delivering over time, whereas autos, for instance, is very volatile. It might be cyclical, but at the time of a slowdown in the global economy, we don't think that this makes a lot of sense. On slide 22, to wrap things up, I would say the following. The Global Investment Committee has been fairly conservative in December compared to what we had last November, so we left things largely unchanged. 2021 was a year characterized by mean reversion. It was a year when we were strongly overweight equities. We had an 11% overweight, and we had a corresponding 11% underweight in total fixed income and cash. As of December, we had reduced throughout the year this overweight equities to 6%, and we were underweight an equivalent amount in fixed income for the reasons that we mentioned above. So the allocation has moved sufficiently, significantly. We continue to struggle to see much value in the current level of bond yields, especially if we think about the European government bond space. And we certainly do not want to be in cash or short-term US Treasuries. The largest equity overweight is our 3% global healthcare. So alongside what we perhaps presented as very specialized weighting in dividend growers of 10% across what we see as the medium risk level 3 portfolio, these are the kind of investment strategy that we think make a lot of sense today for the equity market in particular, and ones that we trust these strategies to deliver income amid a level of still extremely low bond yields as we look at them from a historical standpoint. So I will now pass on to Jeffrey, who will introduce some of our first themes, long-term leaders for 2022. Over to you, Jeffrey.
Thank you, Guillaume. Good afternoon, everybody. It's a pleasure to have the chance to talk with you again. And I'm going to be talking about our 3 outlook themes for the year. And they straddle everything that we've just heard from Guillaume. So there'll be areas where I'll elaborate. Let's move to the first slide, please. Our first theme we call long-term leaders. And the key message here is that the companies that performed best in 2021 are not the companies that are going to do best this year. So if you look at the chart on the right-hand side, last year, when we had a theme called reversion to the mean, we felt with high conviction that the oversold cyclicals, many of them in services related areas like hotels and shipping, would do well. And they did. You can see that on the chart on the right. But when we look at the outlook looking forward, even as the pandemic gradually recedes, we think that there's the likelihood of less earnings upgrades and also less share price appreciation in that area. The easy money in that area was made last year, but we need to look forward. As Guillaume has touched on, looking forward as we are in this mid-cycle stage, we need to be slightly more defensive with our equity selections. And that's why we're focused on company leaders. But how do we define company leaders? If you look at the bottom left, we've got several criteria and we assess different sectors and then different companies along those criteria. So firstly, we're looking for companies that have either got sustainably high returns on equity or companies that are growing their ROEs from low levels. Secondly, we're looking for sustainably high operating margins or companies coming off a depressed level of operating margins. Thirdly, we like companies where the gearing is either very, very low or falling from a high level. But clearly, what's critical right now as we approach an inflection point in rates is that those gearing levels need to be sustainable. Fourthly, we're looking for areas where we find stability after the period when we've had such a sharp V-shaped earnings collapse and then recovery. We think areas that just show steadiness will be rewarded in share price terms in the year ahead. And lastly, we're very focused on companies not so much with high dividends. Sometimes that can be an indicator of future problems, but really companies which are growing their dividends. And to us, that means focusing on companies with strong free cash flows. Next slide, please. We look at what I've just described through another lens. We use our corporate credit analysts to get a better understanding of balance sheet trends and cash flow trends. And what you see on this chart is how issuers in the corporate bond market, which we would define as junk issuers, so low quality credits, the equities for those issuers did very, very well in the early part of the pandemic. But on the top right of this chart in orange, you can see that the share price performance of those lower quality companies is now deteriorating. In contrast, investment grade issuers have had very steady performance with their equities. And we think that that is going to continue. So it's another way of defining quality. Those companies whose bond issues are investment grade and preferably high investment grade. Next slide, please. What you see on this slide is at the top left, consumer staples, 21% weighting within our definition of an index that comprises companies that are raising their dividend payouts. So what you're seeing here is a connectivity between those dividend payers and also sectors that we regard as high quality, because you'll recall from 2 slides previously, the sectors that stood out along our 5 criteria included consumer staples. And on the right-hand side of this chart, you can see how consumer staples are underperformers. We expect that that is going to turn in the coming months. Next slide, please. If we turn to our second theme, it's very similar to the theme that you might recall us talking about all of last year. Last year, we called it financial repression. And what we were referring to was nominal rates being close to historic lows. And as a consequence, many areas of fixed income and cash were giving negligible returns or even negative in real terms. This year, we think that it's even more the case because we've got higher debt levels and we got higher levels of inflation. So now it's even more important that we focus on ways to what we call beat the cash thief, which in short means maintaining purchasing power in real terms. How do we do that in an environment where sovereign bonds are giving us negligible yields? Move forward 1 slide, please. You can see that we've, on the left, been in a similar situation post-World War II when we had very high debt levels. And during that period, the recovery from that through higher inflation was worked through over many years. And we're envisaging something similar in the coming years at a quicker pace. But what really matters on a 12 to 18-month horizon is the chart on the right. You can see how depressed real rates are. Here we're showing US Treasury real yields. And we could show similar charts for other fixed income assets. So where do we go to generate income within a portfolio? Let's look at a few areas. Next slide, please. So where we're focused on the listed side within fixed income is the middle part of this bar chart. We're looking at areas like emerging market debt. We're looking at bank loans, particularly floating rate loans. We're looking at high yield bonds. If you look at the very bottom of this chart, the very best sovereign bond that we can find, US Treasuries, is the very least attractive of the entire fixed income universe. That's telling us that with such a big asset class, it's going to be a challenge to find these income generating opportunities. That's one of the underpinnings for our underweighting in fixed income in broad terms that Guillaume referred to. But let's look at 1 or 2 of these areas in just slightly more detail. On the next slide, what we're showing on this page on the left is how high yield bonds correlate very closely with high yield loans. And loans offer not just the same yield, but also similar returns over time with less volatility. So in risk reward in the next year, floating rate high yield loans look attractive to us. On the right, we have been really positive on US high yield. We still are. We also are looking for an entry level in emerging market debt, which has rallied particularly strongly over the last few years. And we think that a pickup in yield there will give us that entry point. And on the next slide, 31, another way to generate income if we don't find sufficient opportunities within the traditional fixed income universe is by selling volatility. And that's because we've got, in most asset classes, a significant difference between implied volatility and realized volatility. Now, this chart shows for treasuries how the volatility has come down from its lows in the worst period of COVID in Q2 2020. However, the level we're at now is higher than the historic average of the previous 10 years. And we think that's going to be maintained. So this elevated volatility, we think, will give us opportunities within our capital markets business to develop structures where we can sell volatility to generate decent coupon products. On the next slide, here I'd like to just focus on the right-hand side, where we show our strategic return estimates. These are internal forecasts by asset class in real terms. And if you look at the fixed income numbers, third and fourth on that table, the returns are low, especially in areas like investment grade in the developed world. And that's why we're under pressure this year to find alternate areas that generate income. Now, we've touched on a couple already. Within equity, we've talked about companies that are growing their dividends. Guillaume showed a couple of charts elaborating on that. But let's now turn to our last theme, where we think that we can supplement some of our income earning areas with areas that offer long-term growth. Next slide, please. You've heard us talk about our unstoppable trends at previous outlooks. What do we mean by unstoppable trends? These are firstly long-term trends, more than our typical 18-month horizon that we use within our Global Investment Committee taxonomy. These unstoppable trends have got structural underpinnings that will give us long-term sustainable growth. That growth needs to be reflected in investable universes. And we need catalysts that are likely to give us near-term performance in these unstoppable trends. And what's very interesting this year is that we haven't had to change the unstoppable trends that we're focused on compared to last year. And that's because last year, these trends actually underperformed in share price terms. If you turn to the next slide, on the left, we show for one of these unstoppable trends, alternative energy, that we call greening the world. You can see in purple, the top line on that chart, how the stocks within clean energy underperformed last year. They had a spectacular 2020. Last year was difficult. And we found that more widely across all of our unstoppable trends. The reason is very tied to the comments we've already made. Last year was a year of recovery in cyclical recovery stocks, areas that benefited as the worst of COVID was fully discounted. With all the money focused on those areas, these unstoppable trends were sold down, didn't attract fresh buying, and yet the underlying fundamentals continue to improve. If you take green energy, in the last year, we've had a huge increase in government commitment to the area, both verbally and in terms of fiscal spending, catalyzed by the Global Climate Conference in Scotland in November. But in addition, we've had many new issues, many in the corporate bond market, but particularly a very high number of equity issues. And that's giving us a great universe of alternative energy companies, wind and solar producers, for example, which are listed, have got track records, and we think the earnings growth is powerfully strong. You can see on the right-hand side of this chart that these unstoppable trends, you can see the ones that we're talking about on the bottom of this page, they've also got quite high volatility. So in addition to having the alternative of buying into these areas with equity purchases, we can also look to generate income in these areas through baskets of, for example, digitalisation, which can capitalize on the high volatility with a product with a decent coupon. So you get growth plus potential coupon from this area. Let's move on another slide, please. Let's move one forward. There's two areas within digitalization that we are really excited about this year. The first is cybersecurity. And as we become more networked, communicating and working in a much more mobile way, driven by 5G, at the same time, we're finding big needs, increasing needs for security of the data. And as a consequence, global investment in cybersecurity is rising very, very strongly. And we think that's going to continue. And the companies that are involved, you can see on the far right bar chart, they are delivering very solid revenue growth and increasingly decent profits as well. Turning to the next slide, also within digitization, you saw the e-commerce slide on a shorter term time frame earlier from Guillaume. Here you see our long-term forecast is very much same trend, but what's even more interesting for us now is driving that e-commerce is the logistics area. So it's companies that are able to mobilize the goods that we're all buying online that are doing very well. And that includes on what we show here on the right, areas like warehouse construction, where spending is rising very, very strongly. So within digitalization, we like cyber, we like e-commerce and related areas of e-commerce. On the next slide, an area that we've touched on in previous outlooks, Guillaume's already told you that we overweight the healthcare sector, but what's driving the healthcare sector is not so much the pandemic. Clearly, areas like telemedicine are more widely used now than 2 years ago. But we think when we're thinking about unstoppable trends, we need to think longer term. And the big story here is longevity. Many of us will hopefully live longer because of not just demographic trends, but technology trends. And those technologies are driving the healthcare sector. And what you can see on the right is how the over 65s as an age group are growing 4 times faster than any other age group over the next 30 years. And it's that age group that will be spending on healthcare, driving and forcing the technology changes. And on the final slide, our last unstoppable trend, the G2 world, again, similar to last year, it refers to Asia and US driving global output and global trends. But we're particularly focused on the Asian part of that unstoppable trend this year because of Asia's underperformance last year in share price terms. We continue to like what we've been focused on now for several years, and that's the rising Asian middle class. On the right-hand bar chart, you can see in green how that middle class is rising so quickly, and with it, spending power. So you can buy into the Asian consumer story, or you can buy into the manufacturers who are selling to the Asian consumer. So bringing things to a close of our formal remarks, we've heard an outlook where there's no boom, no bust in the coming few months. We expect both growth and inflation to ease. It's a great environment still for equity, although we've reduced our overweighting, but within equity, you need to be focused on areas of long-term growth and dividend payment growth. Those are the 2 areas we especially like. And within those 2 areas, it's the quality companies, as we've defined earlier, that you should be focused on. Within fixed income, a tougher environment, focus on some of the traditional, more risky areas of fixed income, like emerging market debt, high yield bonds, variable rate loans, and being very, very selective by issuer. In portfolio construction terms, stay invested. Always, we think, continue to be diversified, but that's particularly important this year. And that applies in both equity and fixed income. And finally, be selective in the year ahead. We'll get less gains at the index level. So not a year for chasing beta, it's going to be a year for seeking alpha by being more selective. I'll close there. That closes our outlook from Guillaume and I. And I'm going to hand over to Julian Corney, who's head of the foreign exchange team within the capital markets business, to talk about the outlook for currencies. Over to you, Julian.
Thank you very much, Jeffrey. And also, I'd just like to follow on from Jeffrey's comments on the selective part. But before I get to that, I'd just like to say hello to everybody and all the best wishes for the year ahead. So on the selective part that Jeffrey just finished on, I think that's extremely important when we look at the year ahead in currencies. With currencies, it's often obviously a macro trade, macro landscape. So I think it's quite useful to take a step back and just look at things from a much bigger picture before we drill down into the various currencies and the nuances around that. So first of all, I guess I should just start by saying that from Citi's perspective, the house view, the forecasts are for the dollar to be slightly stronger relative to the year starting points. But if we just take a step back, as I say, and we look at things, in the last few months, the whole landscape of currencies and also of interest rates has completely changed. So since 2008, we've been living in a world where monetary and fiscal policy has been extremely loose, as you've heard from the previous speakers. And the combination of these two has obviously been very positive for risk assets. But if we look at what that means for the dollar, if you go back to 2008, the dollar index was trading around 70. It's currently trading around 96. So that's a 35% increase in the value of the dollar relative to the European, or sorry, the G7 currencies. So a significant performance by the dollar in a very friendly credit environment for consumers. Now, if you look last year, what does that mean in relation to inflation, which is obviously the buzzword on everybody's lips these days? Citi has an inflation surprise index, and within that index, you typically see the numbers sitting in a range of between -20 to +20 based on expectations. Obviously, as inflation expectations and surprises potentially increase, that number goes higher. So if you look at where is that today, we look previously back to July of last year, we peaked to 86. So significantly higher than that -20 to +20 band that I'm talking about. Typically, when you see a breakout of that band, it peaks and then it retraces back into that. So you might see a move, for example, historically, we've seen them up to about 40 and then a retracement back below 20. So last year we peaked in July 86. We're currently at 64 and trending sideways. So we've got an extremely elevated number. Obviously, we're aware of the items around COVID and supply chain issues, etc., which have led to some of this. But the one thing it has done from a markets perspective and investing perspective, and then into currencies, is it's meant that interest rate hikes are now very aggressively priced into rate curves pretty much across the board. And then the expectations there and then the way that the market reacts to that is obviously significant. So if we just look at the economic side of things, on the US, for example, on the economic growth side, we can see that in the States, the year-on-year growth peaked actually in the second quarter of last year. So since then, growth is still extremely positive, but it's been decelerating. And inflation, we expect, is likely to peak around sort of Q1, Q2 of this year. So from a rates perspective, I think this makes things a very, very interesting time. And looking at what's been priced in by the market will really determine what drives potential risk, but more importantly, then brings that back to currencies. And that's why you've seen a lot of movement year to date, and you did at the back end of last year. So I think really it's quite an exciting time and an important time to be looking at FX exposures, because when you need to really be thinking about how is the US going to fare in the year ahead, both on its own, but how will the rest of the globe fare and how is it positioned and will react. So this traditionally over the last 12 years or so, there's obviously been idiosyncratic items around different currencies, but at the same time, what you've generally had is an EM versus DM sort of complex. So emerging markets versus developed markets. But now you're going to see a much more granular analysis within emerging markets and within developed markets themselves. So the classic example of this, just to give you an example, is in emerging markets at the back end of last year. We saw an awful lot of interest in this space around Turkey. Now, I'm not going to go into great detail around that, but it's just to paint the picture. If you look at Turkey as a country, it's got an enormous dependence on energy and imports from abroad. The strength of the dollar over the last 12 months has been really strong. Monetary policy has been a bit vague, and that's been used aggressively to try and stop some of these currency devaluations, but it's not been very effective. So really what that means is now a country like this has now ended up in a position that's very different to where it was before, pre-COVID, and the way that it's had to deal with some of these inflation metrics. So bringing this back to the G10 environment, really this year what we've seen already is a big shift in focus into people following these interest rate moves and what's happened over the Christmas period. So to put that into context, interest rates obviously extremely low. So from a percentage basis, the moves have been incredibly high, but from an absolute basis, interest rates are extremely low still. So if you look at the UK as an example, if you look at 5-year UK interest rates, if you went back to late November, these rates were sitting around 0.6%. 3 weeks later, they've increased substantially to 1%. So sterling, as a result of that, has been supported on this news and on this move. Currently, for the year ahead, so from where we stand today until the end of the year, there's another 105 basis points, 101 basis points, sorry, priced in today. That's come down slightly from 105 about a week ago. And really, I think from a sterling perspective, so sterling dollar or cable perspective, that initial run higher on the UK rate side, and let's not forget UK's already raised rates, looking at another potential raise in February, and that's what's led to the sterling move that we've seen higher back up towards the 137 level. That rate differential has since narrowed slightly, so US rate expectations, i.e., have picked up, so they've moved up to about 94 basis points for the year ahead now, whereas the UK's contracted slightly towards 1%. But either way, when we look at this, I think there's really two messages here when you take this sterling example. Rates are moving quickly based on central bankers and the way that they've had to change and the way that they are changing around the monetary and fiscal items that are in play. And then as a result of that, the currency has moved quickly. So sterling went a lot higher, back up to 137. And then in the last couple of days, we've moved a lot lower, back towards 134.5. So really the sort of range that you're looking at in the support and resistance points within this is 131 to 136.50. Those sort of areas are the areas where you could potentially get breakouts into new ranges. But really it is a large part is focused clearly on the inflation differentials, but also the carry. So the interest rate differentials between the two currencies is something that when rates and everybody's pretty much at zero and rate curves are relatively flat, it doesn't make an enormous difference. But when that starts to pick up every day, if you're earning interest rate differential between currencies or losing it, that can clearly make a difference to your P&L. And so that's why you see these shifts in positioning. If we just move into Eurodollar, euros remained quite heavy. We did have a rally in the last couple of weeks, and that was really more position-based, and some expectations that maybe Europe would actually start to play catch up a little bit on the rate side. Now, the expectation is that we're not going to see any EU rate hikes. Obviously, the dollar side, as we just discussed. So euro still does remain heavy. Rallies continue to be sold, as we've already seen this year. And then we think that there's a potential for a slight move lower. Our forecasts are for the end of the year for Eurodollar to be at 113. But we think that maybe there's the potential in the short term we could move back towards a 110 type area. However, obviously this is based on the movements that we see in the dollar. And I think within this, really, in Eurodollar, there's maybe a little bit more at play in the sense that if Europe did have to start moving on rates, as I said, it's not our base case, but if that was the case, then that could potentially add some support to the euro side of the equation. But on the dollar side, obviously, there's room for disappointment or acceleration there, although probability-wise, you'd probably say there's slight room for disappointment. So looking further ahead, we almost need to take it quarter by quarter. But I guess there is the potential, if that sense of disappointment does come, not just within the dollar rate curve, but across other rate curves as well, which I'll touch on in a moment, that Eurodollar could potentially squeeze higher, given this huge dollar run that we talked about in the dollar index that we've seen over the last 12 years or so. Clearly that is potentially vulnerable. On the euro sterling side of things, so crossing those two up, We actually saw a move down to a big support level at 83 back on Thursday. We've bounced quite aggressively on that up to 83.70. There's a real congestion area here up towards 84. If that can break, then we can potentially see it back up towards 85.5. But I think on the balance of things between euro and sterling, we expect sterling to outperform euro this year. On the Canadian side, so flipping into the more commodity space, this is where I think things can get very interesting. If you look at rate hikes that are priced in here, they're extremely aggressive. So Canada, as an example, you've got 135 basis points of hikes priced in. Now, clearly, they've had a booming housing market, as a lot of the world has with real assets. But clearly, there's potential here for that to maybe disappoint. But for the moment, given the whole energy complex, the way oil prices are moving, that's obviously been very well supported. And it's something that clients still seem to enter into. Positions are long, but that's something clearly to have on the radar in case there's any retracement within that energy story. In terms of Australian dollar, even as early as sort of Q1, Q2 of last year, Australia was still sitting in the position where they were talking about yield curve control. So rate hikes weren't even on the horizon for the next few years. That's reversed very quickly, and actually overnight the Australian CPI numbers came in. They were very strong. You saw the back end of the interest rate curve move 10 basis points higher, so Aussie rallied, and that's since retraced slightly, so back to 5 basis points. So Aussie has declined slightly. But I think really, again, this is a story of when do central banks move, if they believe they're behind the curve on inflation, and how they manage that individually going forwards. Clearly, with the Australian story and the China impact is substantial, and that's an area where I think it's one to watch for this year. Last year could probably, in a very broad generalization, be swept along as saying that China was doing a lot of housekeeping, a lot of cleaning. US obviously outperformed China, corrected substantially, and maybe this year, looking ahead, China can find its feet and rally slightly, whilst the US obviously takes a little bit of pain from a risk standpoint, as we've already seen so far this year. And then maybe there's a little bit of a correction there. So from a relative value standpoint, I should add. So that's something that we're watching carefully, looking how things play out in the weeks ahead and the months ahead. But I think really just to conclude, there'd probably be just 2 points I'd mention around this. Volatility, it's been rising. Okay, so if you look at what's happened just in the last couple of days, yesterday as an example was the biggest sell-off we saw in stocks since June of 2020. Now, whilst that is obviously substantial, if you look at volatility, the rises and the jumps that we saw in volatility within the stock market yesterday was actually not that was actually quite common. So we saw these numbers starting to happen back in November and December of last year. So what you've got is a little bit of a disconnect where you've got the cash markets moving rapidly, but the volatility markets have actually been seeing these sorts of moves more recently. So people are obviously looking at things like hedging, looking at the potential for risk, monitoring risk markets given this change in the monetary and fiscal stance. And then finally, just to say, obviously, always be aware of geopolitical issues. So clearly Russia and the story there at the moment is a prime example of that. And I think I'll leave it there and I'll pass back to Elna. Elna, I think you're on mute.
Thank you, Julian. Thank you very much, Jeffrey, and thank you, Gian. And I think we are already 1 hour, but we have some questions. If you don't mind, I'll bow to you. We have a few questions from our participants. And one of them is on the slide 5, Gian, there was a total return estimate of 8%. And the question is, can you break down global equity total return by region? For example, I'm only interested in US markets versus Europe or emerging markets. Is it possible to give any estimate on this?
We don't provide an individual market breakdown, but I can refer you to what our colleagues do within City Research for their EPS growth forecast in 2022. Their global is 7.5. North America is 7.9. Europe is 5.7. Japan is 11.5. Asia Pacific ex-Japan is 8.2, LATAM is -10 because they had an exceptional year this year. So there'll be diverse growth rates depending on what 2021 was like. But also I think the key takeaway is that it's good to be exposed to global equities more broadly rather than be too region specific from diversification standpoints, and also because if you think you get the story right in one area, you might get quite wrong in another. So the global picture, I think, is more relevant from this particular angle.
Thank you so much. And another question regarding the recent volatility. The markets have been very volatile lately. Do you see any inflation surprise that is not factored in?
I think from an inflation standpoint, it's going to be very, very hard, as I said earlier, to get upside surprises on inflation, given how large the base effects are going to prove to be from a mathematical 12 months change standpoint. You'd need the commodity complex to increase at the same rate as it did last year. And if the mean reversion trade is what happened last year, this year is the mid-cycle slowdown. Therefore, inflation should most likely follow that downward trajectory that we're expecting for GDP growth. Now, geopolitical factors could be something that could intervene in the short term to derail, at least on a sort of 3 to 6 months view, this peak in inflation. But historically, I've never seen high oil prices being sustained when it becomes very attractive for many oil producers to break the cartel and to try and gain market share. So I don't think that there is a very strong argument for high commodity prices going forward in a slowing mid-cycle global growth environment.
Thank you. And if you don't mind, maybe the last question, what possible investment opportunities do you think beginners should look out for in 2022?
Let me start and then hand over to my colleagues. And I want to just highlight 3 things that beginners might be tempted to do, but they shouldn't. Firstly, avoid within equities companies that are attracting headlines. So it might be companies like Peloton and Netflix that have been great businesses in the last year, great share prices in the last year, but are due a pullback. The second thing to avoid is to be swept up in some of the momentum in the recovery plays, especially as we open up further areas like travel. The third suggestion that I would have is to avoid over trading in an environment that's going to be very, very volatile. Our advice is based on historic work that shows that staying invested is the best approach, especially in volatile environments, because our work shows that if you, for example, look to trade out of a current period like this week, it's then very challenging to get back in at the right time. And the biggest gains tend to be made at the very bottom of a recovery phase. So those are 3 suggestions I'd make for what not to do. Guillaume and Julian might want to elaborate on what we should do, maybe summarizing what we've talked about already.
I think maybe just a very brief comment from me. I would just say that, if you are starting out, this year does look like it's going to be a higher absolute level of volatility. Obviously, we've seen that already. It's not to say every week's going to be like this, but I would just say whatever you are doing, probably to Jeffrey's point, don't look to jump in all at once would probably be my very simplistic advice, right? Obviously all sorts of different investment ideas, whatever asset class it might be in, and I think they'll present themselves at different times. But my sort of just one piece of advice would be that whatever you do, just think it through, and as Jeffrey says, don't just follow the crowd into these things, because I think that's where a lot of the danger probably lurks at the moment.
And Julian, also people are asking, where do you see USD versus CHF? Can you give it any?
Yeah, sure. Yeah. So from a dollar Swiss perspective, we've obviously been basing 3 times now around, or 4 times now around 91 level. And I think this is very much a dollar trade rather than a Swiss trade. You know, Euro Swiss also has had a decent move in the last few days. So I think from this one, it's really about playing the dollar. So for the moment, you know, that 91 level is really the one to watch. If that breaks for whatever reason, probably more going to be, as I said, interest rate disappointment related, then you could potentially see dollar Swiss a bit lower. But otherwise, I'd say that it looks supported, and we probably expect it to be higher until we see a game change, most likely to be on the rate space.
Thank you, Julian. Gentlemen, what about they ask about panelist positions regarding precious metals this year? Any particular view or?
Maybe I'll take that one because my desk covers precious metals as well. So obviously, you know, precious metals have had a bit of a boost. Obviously, gold being the one on the inflation story. We've seen interest in platinum. Gold has been a bit of two-way interest. I would say that what you really need to watch here is, more historically speaking, gold is extremely well inversely correlated to real rates. So that's you know, nominal rates or less inflation. So they've been negative now for a long period of time. We've actually seen quite significant moves in those higher, which gold hasn't really picked up on yet. So really, in this strength that we're seeing in gold at the moment, we don't think that's likely to last, given the economic backdrop that we're looking at, one of still of economic growth, even though that might be slowing, which also fits with our forecasts for the bank, which is calling for a move in gold towards the sort of 1600, 1700 level over the more medium term. So we very much see the strength in precious, or at least in gold, to be something that potentially fades. But obviously things like platinum are a much bigger story around the electric vehicle concept, which is obviously going to grow over time.
Thank you very much, Julian. Thank you, Jeffrey. Thank you, Guillaume. Thank you to all participants for joining the roundtable today. Just a reminder for our customers, the full Outlook report may be found on our website. It can be found under the Wealth Management tab, Market Insights. And I think today's roundtable can be finished. Thank you once again.
This concludes today's meeting. You may now disconnect.